Yeah, so thanks for having me, Tyler. So this is even before today's decline. We're starting to see the market technicals start to revert to some oversold levels. Heading into today, there were just a handful of sectors below their 50-day moving average. After today, we're likely going to see every sector below their 50-day moving average. So, you can't get an oversold rally until you tend to hit oversold levels. So we're starting to see the market and some sort of fear levels kick in after a weak start to September, and now Friday and then today really
Yeah, and there are a lot of coalescing factors here that are affecting clearly investor psychology. Everything from China to debt ceiling to Fed meeting tomorrow to all of the other things that are going on in the world. Where is one most likely to find the oversold stocks that might be worth a second look now?
So I think in the industrial sector, you're starting to see more oversold stocks in that sector because it's been so weak. Energy is a sector that you're going to start seeing that come through too, and energy is a sector that we like here. I think you're getting to the concerns of the market right now, and they're all very well known here. We've been discussing them for a while. Just last Monday, a week ago, the front page story of the Wall Street Journal was concerns grow for an autumn pullback in the market. I don't know about you, but I don't ever remember a front page story on the Wall Street Journal anticipating a market decline. So you tend to not see those kind of headlines when you have a complacent market. You also seen in the options market, you've seen the skew, which measures the price of downside protection versus upside protection, hit levels that we haven't seen since 2018. So there are some levels of concern in the market. Individual investor sentiment saw one of its sharpest declines in over a year last week. So those are things that, even though people say that investors may be complacent and the market is complacent here, these are concerns that have been showing up in the market. And I think going forward, we may see a repeat this winter of what we saw last winter. If you look remember last year, it was in early September when we saw tech and the growth stocks peak in relative strength and then pull back. And it was heading into the winter as the COVID wave cases and hospitalizations and deaths were ratcheting up that you started to see outperformance of the cyclicals and the economically sensitive stocks, which you wouldn't expect to see given those negative headlines. So I think we're starting to see COVID headlines and case numbers sort of stall out here. Mm-hmm. And the whole concern on the market recently has been this stagflation argument. But since the beginning of last week, we've seen better than expected manufacturing data, better than expected retail sales, better than expected home builder sentiment, and weaker than expected CPI. So, it's just 6 days, but that tends to lend less credence to the stagflation and more to the temporary factors that we saw in August of weaker manufacturing and throughout earlier in the year of the higher inflation numbers.
Which, Paul, would then fit with what a lot of people have been telling us, which is that they want to buy energy right now. They want to buy financials. They think that cyclicals are going to kind of lead the way out. I guess I was just going to ask, tactically speaking, if you think, I forget if it was about 4 or 6 weeks ago, we had a Monday where the Dow was also down like 800 or 900 points, and that was it. It literally stopped. It was a one-day sell-off. What if this one's something similar? How would we know, other than by seeing how the market closes tomorrow?
Well, yeah, you tend to, these things tend to, in retrospect, Tyler, you mentioned it earlier, pullbacks are always more painful in the moment than they are in retrospect. So we look back, Kelly, you just mentioned that we had another one of these pullbacks a few months ago. And, you ask most people, they won't even remember what it was. They won't remember why, they can't remember why the market pulled back in January of this year, February, March, or in May. At the time, the concerns of the market at that time were that it was going to undo the market. But right now, we don't even remember what caused it. So I think looking back at this period, you may get that same kind of idea. The one major divergence into the market heading like in August and heading into September was that high yield spreads were widening even as the market was rallying. But we've seen that process even reverse itself over the last couple of weeks. So even there, that the biggest fly in the ointment, so to speak, that has started to reverse itself even heading into this week. So I think that's something to watch, what's going on in the credit markets, especially now with China.
Thank you very much.